You're looking for that balanced approach when it comes to investing, and this high-five ETF portfolio you sent over, well, it looks like it might just tick all the boxes:
Yeah.
stability, growth, and even income all together. But let's see if it can really live up to all the hype.
Yeah, it's a very compelling idea, especially when they're showing a 10% average annual return over the last 10 years, at least according to back tests. It makes you want to jump right in.
Right.
But got to be careful, got to look at the details. It's not just about what the ETFs are, but also how they all work together and, yeah, what potential downsides we might be missing.
Absolutely. So the video is really selling this as a set it and forget it approach for long-term investors. Just 5 ETFs,
Yeah.
all equally weighted, and you just let them ride. But before we get too comfy, let's meet the players. What do you say?
Sounds good to me. Let's start off with RSP, the Invesco S&P 500 Equal Weight ETF. So it tracks the S&P 500, which you've probably heard of, but instead of weighting companies by market cap like the regular S&P 500,
Right.
this one gives each of the 500 companies, big or small, an equal slice of the pie.
I see. So unlike those traditional S&P 500 index funds where the mega caps like your Apples and Microsofts of the world really have, the biggest influence,
Right.
this one kind of levels the playing field. Does that actually make a big difference in performance, though?
It can. You see, in a traditional index fund, if, let's say, a couple of those mega cap companies have a bad quarter or something, the whole index can really take a dive.
Oh,
But when everything's equally weighted, well, that impact is spread out a lot more, which should, in theory, lead to less volatility.
Okay.
And historically, yeah, it's shown that it actually can even outperform the traditional cap-weighted index.
interesting. So more balance, potentially less risk.
Yeah.
I like it. Next up is IWY, the iShares Russell Top 200 Growth ETF. Now, this one sounds like it's all about, well, growth, obviously.
Exactly. It specifically targets large cap growth companies across all the U.S. exchanges. And here's what's interesting. The video makes this point about other popular growth ETFs, like the KQQ, for example, which mostly focuses on the NASDAQ. They're saying it's too heavily concentrated in tech. IWI, on the other hand, it casts a much wider net trying to capture that growth wherever it tops up, in any sector.
Hold on, though. Didn't they also see something about IWI still having concentration risk? I'm getting a little mixed signals here.
Yeah, that's a good point. It's true that IWI does diversify more across different sectors, but it still has quite a bit of exposure to its top holdings. And guess what? It's Apple and Microsoft again.
Oh, boy.
So, those two still have a pretty big influence over the whole ETF's performance.
Okay, so I'm hearing you. Diversification is definitely a good thing, but relying too much on even just a few big players can still be risky.
For sure.
All right, moving on. Let's talk about MOA, the VanEck Morningstar Wide Moat ETF. I gotta say, this one sounds kind of medieval, like we're building a financial fortress or something.
That's actually a pretty good analogy. MOA focuses on companies that have these really strong, sustainable, competitive advantages. I'm talking about businesses like Coca-Cola, Disney, the kind of brands that are so well known, they can weather any economic storm.
Yeah, I see what you mean.
And you want to know the best part? They also use equal weighting for this one, so you get even more diversification and reduce risk.
Wow, so it's like a double layer of defense.
Yeah.
Companies that are built to last, plus a portfolio structure that spreads the risk out nicely. I like what I'm hearing so far.
Now let's shift gears a bit, talk about the part of the high five that's supposed to bring in that income. First up is PFF, the iShares Preferred and Income Securities ETF. This one's all about preferred stocks.
These are kind of like a hybrid thing, right? Like somewhere between stocks and bonds.
Yeah, you could see that.
The video was talking about them having these higher yields, which is great.
Yeah.
But also being riskier than bonds, which is not so great. Can you break that down for us a little?
Sure. Preferred stocks, just like bonds, they pay a fixed dividend. But unlike bonds, they represent actual ownership in the company. So that's why they're generally considered to be a bit riskier. The main appeal of PFF in this portfolio is that high dividend yield, like you said. It's sitting at around 7% right now, and also a good chunk of their holdings are in those big financial institutions, the ones that are too big to fail,
So they're basically betting on the big banks to stay stable.
Pretty much.
Okay. But what makes a dividend qualified exactly? And why does that matter for, like, tax purposes? I'm not sure I totally got that from the video.
That's a great question. Qualified dividends are usually paid by REITs and sometimes preferred stocks, and they're taxed at a lower rate than your regular income. So knowing this can help you decide if it's better to hold PFF in a taxable account or in a tax-advantaged one like a Roth IRA to get the most bang for your buck after taxes.
So there are definitely some smart tax moves you can make with this.
All right. Gotcha. And last but not least, rounding out the high five, we have VNQ, the Vanguard Real Estate ETF. So now we're getting into REITs.
Right. REITs, or real estate investment trusts, own and often operate income-producing real estate. We're talking about office buildings, apartments, shopping malls. They're attractive because they diversify your income beyond stock dividends. And VNQ is yielding about 4.5% right now. Not bad.
Not bad at all. But the video did say that REITs can be kind of sensitive to interest rate changes and economic downturns, right? So I guess it's not all sunshine and rent checks.
That's true. There's always a trade-off. Understanding the potential downsides is super important when you're trying to decide if this portfolio really matches your comfort level with risk. But anyway, we've met the high five. It's a pretty diverse bunch.
It is. They've got large caps, they've got growth, established companies, and ways to make income from different sources. But how does it all fit together in the end? Well, the real magic of this high five portfolio, it's how these ETFs all work together. You see, it's not just about the individual parts, it's more about the overall strategy and how they, play off each other.
So it's like a basketball team. You need a good point guard and a center and a three-point shooter. I mean, they each have their own special skills, but it's the teamwork, right? That's how you win championships.
Exactly. But in this case, the teamwork comes from that equal weighting strategy. That's a big part of what makes this portfolio tick.
Okay, I get the concept, but I'm still not quite clear on how the equal weighting actually plays out, in real life. Can you walk me through that?
Sure. Let's say you have, I don't know, $10,000 to invest in this high five portfolio. With equal weighting, you'd put $2,000 into each one of those 5 ETFs.
Got it. So you start off with a nice balance, 20% in each. But I imagine over time, as the market goes up and down, those percentages are going to change, right?
Oh, for sure. Some ETFs are going to do better than others. That's just how it is. And that can throw the balance off a bit. That's where rebalancing comes in.
Ah, yes, rebalancing. The video talked about that, but I'm not sure I totally get it. Does it mean you're constantly buying and selling to keep those percentages exactly the same?
No, not constantly. It's not about obsessing over tiny little changes every day. But it's smart to look at your portfolio maybe once a year, or maybe every 3 months if you like to stay on top of things, and then see how much those allocations have drifted.
So let's say IWI has grown to like 30% of my portfolio, but MOA is down to 15%. I'd sell some IWI and use that to buy more MOA to get back to that 20% target for each.
Exactly. Rebalancing keeps your portfolio on track, it manages risk, and it kind of forces you to buy low and sell high in a systematic way.
That makes sense. You're taking the emotion out of it. But speaking of things we can't just ignore, what about taxes? Especially with those dividend yields we talked about from PFF and VNQ. Those are pretty high. I bet the tax man is going to want a piece of that action.
You're right to think about that. Those dividends can be great for income, but you do have to be smart about taxes. Like we said earlier, those qualified dividends, the kind you usually get from REITs and some preferred stocks, well, they're taxed at a lower rate than regular income.
So that's good. But are there other things you can do to, keep those taxes down? The video mentioned Roth IRAs, but what if I'm already putting the max in there?
There are always other options. Like if you're investing in a taxable account, look for ETFs that are known to be tax efficient. That means they don't create as many taxable distributions. And hey, if you've got a financial advisor, they can help you with strategies like tax loss harvesting. That's where you use your losses to offset your gains.
So there are ways to be strategic about it, even with taxes. I guess what I'm realizing is that set it and forget it doesn't mean you completely ignore your investments.
Exactly. Even with a passive long-term strategy, it's still important to stay informed, make adjustments when you need to. But the good thing about this high five portfolio, it is designed to keep those adjustments to a minimum.
Okay, good. I like to keep things simple, especially when it comes to money matters. But, talking about all this, it makes me think that this high five structure, this is just one way to use ETFs.
You got it. That's what's so cool about ETFs. They're like building blocks. You can kind of mix and match them to create whatever portfolio you want, something that fits your goals, your risk tolerance, even your values.
So this high five, it's a good starting point.
Yeah.
A blueprint, we could say. But it's not like set in stone or anything. You can change things up. Swap out ETFs, play around with the weighting. I mean, the possibilities are kind of endless.
Exactly. And that's where it gets really interesting. It's less about following someone else's recipe and more about understanding how to build your own portfolio. Like, let's say you really think growth is the way to go. Maybe bump up your IWI allocation. Or maybe you're getting close to retirement and you need more stability, more income. Maybe shift more towards PFF and BNQ, or even add a dedicated bond ETF into the mix.
Okay, I'm getting the bigger picture now. This high five thing is more of a framework, a foundation. But the real power is knowing how to make it your own. But let's be real for a sec. All this talk about returns and rebalancing, it can feel kind of cold and calculated, right? I mean, we're humans, not robots.
So true. And that brings us to a really important part of investing that often gets overlooked. I'm talking about the psychological side. The high five, it's designed to help you make less emotional decisions with its focus on the long game and not trading all the time. But those emotions, they're still there.
You're talking about the fear and the greed, the kind of stuff that makes people do crazy things with their money. Like when market dips, they panic and sell everything, or when they hear about some hot stock on the news, they jump in without thinking.
Yeah, exactly that. Our brains are wired to react emotionally to these market swings, and that can totally wreck even the best plans. But that's why having a good strategy, understanding how compounding works, and remembering why you're investing in the first place, all of that can really help.
So it's about making a plan, sticking to it, and not letting all the ups and downs make you lose sight of your long-term goals. Easier said than done, I know, but I see what you mean. It's like training for a marathon. You don't just give up because your legs hurt a little on the first mile, right?
Perfect analogy. Investing for the long term, it's totally a marathon, not a sprint. And the high five, well, it's about creating a portfolio that can run that marathon with you through thick and thin, all the way to the finish line.
Okay, I'm definitely getting this now.
Yeah.
We've talked about the individual ETFs, why they were chosen, and the nuts and bolts of actually managing the portfolio. But before we wrap up, is there anything else we should be thinking about before we give this high five a high five?
I think it's super important to remember that everything we've talked about today, it's just for information, not financial advice. Everyone's situation is different, and what might work for one person won't necessarily work for another.
You're absolutely right. We're just two people having a chat, not financial gurus giving out stock tips or anything like that. It's up to each person to do their own research, look at their own situation, and maybe even talk to a professional if they need to.
Couldn't agree more. And, the high five is just one idea. The cool thing about ETFs is that they open up so many possibilities. It's about finding what's right for you, building a portfolio that matches your goals and your values, and then being disciplined enough to stick with it over time.
That's a great takeaway. This high five has been an awesome way to learn about this stuff, but the real lesson is how to understand ETFs and use them to make a solid investment strategy that works for you. Going through this whole high five portfolio, it's really opened my eyes to just how versatile ETFs can be.
It is amazing, isn't it? I mean, we've used this one specific portfolio as an example, but what we really want you to get out of this is how you can use ETFs, like as tools to build a portfolio, one that really fits your own needs and goals. It's not a one-size-fits-all thing.
That's what I find so cool about it. It's not about just blindly copying what someone else is doing. It's about understanding the pieces, like ingredients, and then making something unique, something that, fits your own financial taste.
I like that, the ingredients analogy. And just like with cooking, you can experiment, right? You might start with a basic recipe like this high five we've been talking about, but then, you can tweak it, try different spices, change the portions to your liking.
Okay, so how can people get creative with their own ETF portfolios? What kind of spices should they be thinking about adding?
One way to really personalize it is to think about your values. Like, there are ETFs that focus on specific things, like renewable energy or sustainable agriculture. So if you're passionate about those issues, you can invest in a way that aligns with what you believe in. Or you could choose to avoid certain industries, like, say, tobacco or fossil fuels, if that's important to you.
Oh, I see. So it's not just about making the most money. It's about making sure your investments match your ethics. I really like that idea.
Right. And you can get even more specific than that. Like maybe you're really optimistic about emerging markets or you think artificial intelligence is going to be huge. Well, guess what? There are ETFs for those things too. The important thing is to do your homework, learn about the risks, understand the potential upside, and then make smart choices.
It sounds like there's an ETF for practically anything you can think of, like a giant buffet of investment options.
Pretty much. But that can also be a little overwhelming, especially if you're new to all this. So my advice is to start with the basics. Know your risk tolerance, set clear financial goals, and then build your portfolio slowly. Start simple and get more complex as you learn and get more comfortable.
Start simple, learn the ropes, and then expand your horizons. Makes sense. So as we wrap up this deep dive, what's the one thing you really want our listeners to take away from all this? What's the main course, so to speak?
The biggest thing is, take control of your financial future. Don't be scared of investing. ETFs are a great way to build a portfolio that's diverse, affordable, and really personalized to you.
I love that. It's about feeling empowered, not intimidated. And remember, you don't have to do this alone. There are so many resources out there, from books and websites to financial advisors who can help you along the way.
Absolutely. And don't be afraid to try things out, to learn as you go, to make changes when you need to. Investing is always changing, and ETFs are changing right along with it. So stay curious, stay informed, and hey, most importantly, have fun with it.
What a great way to end things. Thanks so much for joining us on this deep dive and for all your insights. I feel like I've really learned a ton about ETFs today.
It's been my pleasure. And to all our listeners out there, remember, the high five is just the beginning. There's a whole world of possibilities with ETF investing. So go out there and build a portfolio that matches your own unique vision for your financial future.
And we'll be here to cheer you on every step of the way.
Thanks for listening to The Deep Dive.